Imagine you're trying to steer a raging ocean with a wheel. Sounds absurd, right? Yet in financial markets, many of us do something similar. We try to control and predict chaotic price movements. We make plans and draw perfect charts, but the market still goes its own way. This illusion of control can cost us our nerves and our capital. The market is chaotic and beyond our control. The price curve goes up and down with no visible order. This clearly shows that the market lives by its own laws. It's influenced by thousands of factors, from economic news to the emotions of other participants. There's no button you can press to make the chart go in the direction you want. Mark Douglas, the famous author of The Disciplined Trader, emphasized that the market is a unique environment without the order we're used to. We can't tame the market's chaos any more than we can command a storm to subside. So why do traders and others keep trying to grab that illusory steering wheel? Let's look at where the illusion of control comes from and why it's dangerous. And most importantly, how to let go by developing adaptability and calm in the face of uncertainty. Why does the illusion of control arise? The illusion of control is a well-known phenomenon in psychology. It refers to our tendency to overestimate our own ability to influence random or external events. In other words, we feel that if we analyze and anticipate everything carefully, the outcome will become predictable and under our control. The brain loves a sense of certainty. It makes us feel safe. In trading, this illusion is particularly acute. Imagine you did everything right, by the book. You studied the news, you did your technical analysis. You built the perfect strategy. You enter a trade confident of success, but the market suddenly turns against you. The price doesn't go up as expected, it plummets, hitting your stop loss. Indignation and disappointment wash over you. How can this be? I foresaw everything. Why didn't it work? The most dangerous illusion in trading is the belief that you control the outcome of a trade. The truth is, you can't control the market price, it moves according to the whims of millions of participants and random events. You can't control market liquidity or the news cycle. At any moment, unexpected news can break, or a major player can make a trade that moves the price sharply. You can't control the actions of other traders. None of us can force the market to follow our plan. But our brain stubbornly insists, I've planned for everything, so it must work. That's how the illusion of control is born. The belief that the market obeys us if we're smart and prepared enough. Why do we think this way? The reasons lie in our psychological makeup. First is the fear of uncertainty. It's human nature to strive for certainty. Uncertainty is scary, so we want to believe we can eliminate it. The illusion of control is an emotional cushion. I'll be fine. I've got the situation under control. In everyday life, this shows up all the time. For example, someone presses the elevator button repeatedly, thinking it'll arrive faster, even though it makes no difference. In trading, after making a deal, we often desperately seek confirmation that we're right to calm our anxiety. Second, searching for causes and self-deception. After every trade, we tend to explain the result logically. If we made money, we convince ourselves it's due to our skill. If we lost, we blame the unpredictable market. In both cases, we pretend we controlled the outcome, when in fact the result was largely random. Third, confusing preparation with control. We mistake good preparation for a guarantee of success. Yes, we can and should analyze the market, planning entry and exit. That is within our power. But it is not equivalent to control over the outcome. You can prepare perfectly, yet the market itself does not obey you. Fourth, the temptation of success. Paradoxically, several successful trades in a row can reinforce the illusion of control. Win 3 or 4 times and the thought arises, I think I've cracked how the market moves. I now understand the market for sure. In reality, you might have just hit a favorable streak of randomness, what is statistically referred to as positive variance. If you forget this and imagine yourself omnipotent, the next series of losses will be a shock. Sooner or later, reality will knock the overconfident off the board as the market constantly changes and doesn't forgive arrogance. So, the illusion of control is a trap that is easy to fall into. It is born from a natural desire to protect oneself and from successes that deceptively convince us of our own correctness. What does this illusion lead to? Let's see why it hinders a trader's success. Why is the illusion of control dangerous for a trader? The illusion of control is not a harmless misconception. It truly hinders market adaptation and professional growth. When we believe we have the market on a leash and we don't, the consequences can be painful. First, the illusion shatters against reality, and this takes a toll on the psyche. As we've described, a trader can flatter themselves with the confidence that everything is under control, but the market sooner or later rubs your nose in the truth. Imagine you stubbornly ignore danger signals, increasing your position, confident in your correctness. And suddenly, a crash. The market behaved incorrectly. Illusions crumble in an instant. A person feels shock, disappointment, even trauma. How can this be? Everything went off plan. Fear appears. The trader begins to perceive the market as a hostile element from which there is nowhere to hide. A fear of mistakes arises, a fear of missing profit or losing again, and it paralyzes the will to act. The irony is that by trying to avoid losses at any cost, a person achieves the opposite. Fear makes us rigid, preventing us from making the right decisions. We start acting either too impulsively or we freeze up entirely. And the market, meanwhile, does not wait. Profitable opportunities slip away. Second, perception is distorted and objectivity decreases. When we're obsessed with being right, we unwittingly filter information, noticing only what confirms our forecast and ignoring signals that the market is going another way. The illusion of control makes the mind inflexible. Instead of admitting the scenario is changing and needing to adapt, a trader in the illusion will insist on their own way. It's temporary. It'll turn around now. I've calculated everything. Such stubbornness prevents exiting a bad position in time or entering a new promising trade. After all, admitting the error of the original plan is psychologically difficult. As a result, losses grow, profit is missed, and growth stops. Third, the illusion of control leads to a breach of discipline and an overestimation of risk. A trader who believes in their omnipotence may start to overdo it. Too frequent trades, excessive position sizes, neglecting stop losses. Because it seems to him that he is so right that the market must go in the right direction. Studies note, the illusion of control pushes investors toward more risky behavior. It's like a gambler who, after a couple of wins, decides to bet everything, convinced that luck is under his control. The end of such a story is well known. The market impartially takes its own. One sudden unfavorable turn and a big loss becomes the inevitable price for overconfidence. Finally, the illusion of control hinders learning and development. If we credit all successes to our genius and all failures to external wrong circumstances, then where are the conclusions and lessons? Such a trader doesn't grow, he doesn't improve strategy, doesn't work on mistakes, doesn't develop psychological resilience. He's obsessed with being right, not becoming better. It's a dead end. Great traders, paradoxically, are distinguished not by the ability to always guess the market, but by the ability to admit and correct their mistakes. The illusion prevents admitting mistakes, which means it prevents becoming stronger. It's worth noting, the desire to control everything around you, it's not just about trading, it's a universal human pattern. But the market is a special place. It quickly and painfully teaches that the illusion of control doesn't work here. As one expert aptly put it, the more you try to control the market, the more the market controls you. We start dancing to the tune of market emotions, fear, and greed, instead of acting with sound judgment. Realizing all this, one can fall into despair. Is there really nothing that can be done? The market is chaotic, I control nothing. Actually, there is a way out. You need to let go of the illusion of total control and shift focus to what is truly in our hands. Paradoxically, it's by accepting our limitations that we gain strength. Let's see how to develop adaptability and calm, stopping the fight with chaos and starting to cooperate with it. How to let go of the situation. The path to adaptability and calm. The only thing we truly control is our reactions and decisions. This is a key insight that sets you free. We have no power over the market, but we have power over ourselves, our attitude, behavior, and choice of strategy. When this thought is finally accepted, there comes almost a sense of relief. The burden of predicting everything falls off your shoulders. Instead, attention shifts to what I will do in any situation. Imagine a surfer on a large ocean swell. He doesn't try to stop the wave or change the weather. It's useless. Instead, the surfer learns to master himself perfectly, keep balance correctly, catch the wave's rhythm, and choose the moment to jump on the board. The ocean doesn't change for him. It's he who adapts to the ocean. He goes with the flow, using the wave's power for his own benefit. Trading is very similar to such surfing. You can't command the price to rise or fall, but you can train your mindset and skills to calmly meet any market turn. When instead of resisting chaos, you start to glide over its surface, flexibly adjusting, trading becomes more stable. Accepting uncertainty, that's what lies at the heart of adaptability. It means internally agreeing. I don't know and can't know for sure what will happen next. And that's okay. Uncertainty is no longer an enemy, but a given that we work with. As soon as you accept the possibility of any outcome, the fear of the unknown loses its power over you. Psychologically, you're ready for anything and don't cling to a single scenario. Accepting uncertainty is the path to freedom of thought and effective actions. For a mind freed from the terror of being wrong begins to see the market objectively and notice new opportunities that remained out of sight in a state of fear. Practical advice: change your mindset from "I must be right" to "I am ready to react." For example, before every trade, remind yourself, I don't know where the price will go, but I know what I'll do if it goes up or down. I have a plan for any scenario. Say it out loud. Such a simple trick will switch you from expecting a controlled result to being ready for any outcome. You'll stop treating the market like a test of being right and start seeing it as a field to execute your action plan. Focus on the process, not the result. In trading, this means instead of guessing every next price tick, focus on following your strategy and managing risks. Discipline is your shield against chaos. If you've predefined your entry conditions where you set your stop loss and take profit, then let the market do whatever it wants. you've already prepared an answer. As Mark Douglas said, control in trading isn't about prediction accuracy, but a sequence of actions. Simply put, it's control over yourself, not the market. You consistently follow your own rules. Then market emotions won't be able to throw you off. With such self-discipline, even a chaotic market stops feeling like a threat. It's just an environment where you act according to your plan. Here's a good exercise. A list, what's in my power and what is not. Take a sheet of paper and imagine a 2-column table. In the left column, write down what you actually control. Position size, risk level or stop loss, entry and exit points, your reactions to profit or loss, your learning and error analysis. This is your area of responsibility. In the right column, list what's beyond your control, where the market goes, when major news breaks, the behavior of other traders, and the individual outcome of each trade. Take a look. The left column represents the levers you can confidently pull. Concentrate your efforts here. The right column is what you need to let go of. Don't waste nerves and time worrying about things you cannot influence. This seemingly simple practice helps clear the fog of illusions. You visually see the boundary between your role and the market's elements. Developing adaptability is constant work on the flexibility of your thinking. Mark Douglas taught traders to become impartial observers of the market. What does that mean? It's the ability to calmly accept information as it is, without distortion from our expectations. If the market brings a surprise, instead of panic or denial, ask yourself, okay, what new opportunity or lesson is hidden in this situation? Be like water. Water takes the shape of any vessel. Similarly, a trader's flexible mind adapts to current market conditions. Today, there's high volatility. He reduces positions and manages risk more strictly. Tomorrow, the market is calm, it doesn't require extra moves, and he patiently waits for his setup. A flexible trader doesn't argue with the market, he cooperates with it. To stay calm amidst chaos, emotional awareness is also important. Acknowledge that you're human and can feel fear, greed, or anger from failures. Learn not to act under the influence of these emotions instantly. For example, if you feel panic rising, take a pause and a few deep breaths. Remind yourself, the market doesn't owe me anything. My job is to follow my plan, not to fight the market. Experienced traders develop almost rituals of composure. Some go for a drink of water, others literally step away from the terminal when they feel they're about to make an impulsive move. Composure is a skill that comes with practice and self-discipline. And peace of mind comes from knowing you've done everything possible, set stops, calculated risk, and then let happen what may. You trust yourself to handle any outcome because you've accepted its possibility in advance. Mark Douglas said, the market essentially reflects our inner state and reveals weak spots in our psyche. If you have unresolved fear or ego inside, the market will definitely push that button. Therefore, the path to tranquility lies through working on yourself. Stop seeing an enemy in external uncertainty, look inward instead. What reactions are preventing me from being flexible? Perhaps it's the fear of making a mistake and looking foolish. Then learn to accept mistakes as part of the process. Every trader makes mistakes. That's normal. Maybe it's a habit of controlling everything in life. Then remind yourself that the market is not a case where that works. And try to enjoy the unpredictability as if it were an adventure. Ultimately, the market is the best teacher of patience and humility. Paradoxically, when you accept that not everything is under your control, you'll feel more confident in trading. This confidence isn't about being right, but knowing that whatever happens, I'll handle it. Here are a few practical techniques that help develop adaptability and mental resilience. The rule of pre-accepted risk. Before a trade, determine the amount you are willing to lose. Mentally accept that this money is already spent as the entry fee for the trade. Full acceptance of a potential loss frees the mind. You trade without fear because the worst-case scenario won't throw you off track. Strangely enough, this increases profit chances because decisions are made calmly without panic-driven tunnel vision. Keeping a decision journal. After each trade, record not just profit and loss figures, but also your thoughts and emotions. What did you expect? Did the expectation match reality? Did you have an illusion of control this time? For example, I was sure the price wouldn't go below level X, but it did. Such a journal develops self-observation. Over time, you'll catch yourself before a trade. Wait, I'm too sure of the result, so the illusion is strong now. I need to be more careful. The journal disciplines you and shifts focus from the result to the process and analysis, which is what's needed. The stop thought technique. Before entering a position, ask yourself, if the market goes against me right after entry, can I exit at the stop without emotion, or will I start making excuses to stay? If you catch yourself on the second option, the illusion of control and unwillingness to accept a mistake have activated. It's better to reduce the position or even skip the trade than to enter with that mindset. This technique trains you not to identify yourself with every single trade. Remember, each individual trade shouldn't define whether you are right or wrong. It's just a probability that either played out or didn't. You can always enter again when conditions are favorable. Over time, practicing these methods, you'll notice something amazing. Calmness and adaptability will become second nature. The market no longer seems like a chaotic monster. You accept its chaos and know how to live within it. In moments where you used to panic or get angry, you now act with composure. Where you once tried to fight every wave, you now glide on a surfboard, even enjoying the process. And results, as a rule, start to improve, because a calm mind, open to new scenarios, sees more opportunities and cuts losses without ego, letting profits run. There is wisdom in the market's chaos. It teaches us to let go of what's beyond our power and gain control over what truly matters, ourselves. Mark Douglas noted that the market mercilessly shows a trader their internal problems. But once you accept that you can only control your behavior, strength replaces stress. Fear and anger fade away, while focus and confidence arrive. This is exactly how professional traders stay calm when there is panic all around. They know their success is built on internal balance, not on guessing the market. The illusion of control is a set of shackles that we put on ourselves. Trying to control the uncontrollable only exhausts and disappoints you. But once you cast off these shackles, true liberation arrives. Accepting uncertainty grants you freedom of thought. You are no longer constrained by the fear of being wrong. Your mind is flexible and open. Accepting chaos grants you efficiency of action. You act based on reality, not illusions, so your decisions are more accurate and timely. Letting go of the situation doesn't mean becoming passive. It means, like a martial arts master, using the opponent's strength to your advantage. Without trying to break the wave, you ride it. Without demanding the market fulfill your desires, you learn to listen and find harmony between your strategy and its movements. As a result, that very sense of peace and agreement with the market that Mark Douglas wrote about arrives. You are no longer at war with it, but working together. Paradoxically, it is the refusal of total control that gives us the best control over the situation. You control yourself, which means no market storm will catch you off guard. So, let go of the illusion that you must predict or hold the market. Focus on yourself, your discipline, your plan, and your attitude. Chaos will stop being scary when there is order inside of you. After all, in the end, to conquer the market, you don't need to control it. It is enough to learn how to control yourself. This is the path of the disciplined trader, the path to success through inner freedom and harmony with uncertainty. Key ideas are taken from psychological principles set out by Mark Douglas in The Disciplined Trader and from the experience of traders who learn to let go of the illusion of control. May these ideas help you find peace and success in any turbulent market waters.